Well, is today's downturn in stocks a correction to the recent rally or the beginning of another downturn? One way to answer that question is to look at the historic price movements of major market indexes. Katie Stockton, Chief Market Technician at MKM Partners, joins us now with her technical analysis. Katie, welcome. It's great to have you.
Thank you.
All right, so if you would first just sort of characterize what we're seeing with the markets.
What you're seeing the major indices do today is break down from an intraday trading range. That's important really over the short term, not over the long term. I think it's the beginning of a deeper pullback, but a pullback from the big picture would really be constructive for the broader market in here.
So we're looking at, 5%, 10% pullback given the 40, 50% gains we've seen the last couple of months?
I'm looking at the S&P 500 to pull back closer to about 910 to 915. That's where some important support is on the chart, and that would be, in my opinion, a pretty impressive buying opportunity, making it lower risk as we pull back closer to that support level and progressively become more and more oversold.
Has the S&P seen 1,000, at least for the time being? Is that it?
1,000 is a resistance level on the chart because it does hold psychological significance as that round number, 4 digits versus 3 digits, and it also approximates former resistance at that November 2008 high. So it is an important level, but we did see a breakout very recently in late July above former resistance at the January high, and that to me was an important breakout that suggested a long-term target of about 1220, 1230 on S&P 500. So I would view a pullback as a counter-trend move.
And what are you seeing in terms of the Dow? It's currently at 9152.
I use the S&P 500 as my primary benchmark. I think the Dow isn't quite as representative of the broader market, so I focus on the S&P.
Okay, fair enough. We'll leave it there. So tell me then, what fundamentals? I know you focus on the technicals and you're charting everything, but are there any fundamentals you're keeping an extra close eye on that could blow your predictions out of the water?
I don't look at fundamentals, but I would point out today, of course, we've seen Lowe's pull back very significantly on some fundamental news. And instead of looking at that as something very negative, I would actually look at it as a buying opportunity in Lowe's, maybe a little bit lower than where we have it today, and focus separately on the fact that Walmart very quietly broke out above resistance at its 200-day moving average last week. So you're really seeing some positive action in these bellwether retailers.
Okay, so you mentioned Walmart. Other industry groups?
I'm sorry?
Are there other industry groups that you mentioned Walmart breaking out of that trading range? So are there any other industry groups? There's a point that, well, gee, with the sell-off, there isn't, or with with the rally, there wasn't really a leading industry group. Is there anything that is poised to break through?
Well, we've seen financials really pick up on a relative strength basis. So more and more, if you look at, say, the XLFs or the BKX relative to the S&P 500, it has broken out on a relative strength basis. You see these nice inverse head and shoulders patterns on the chart. So that's promising. Short term, it does not make them immune to a pullback. So I would, again, view that pullback as sort of a constructive development over the short term and focus on financials.
Is there a concern, though, that financials were perhaps overbought, given where we are right now?
Right. Most of the market was overbought going into this week, so that's nothing new. It really only matters when you see a loss of momentum. Of course, the greatest example of that would be China. On the Shanghai Composite, we've seen a loss of momentum finally manifest itself as a pullback in that market from prolonged overbought conditions. On a weekly basis, the Shanghai Composite had been overbought since April. So as you can see, those overbought conditions can be sustained for a long time until finally you see a little loss of momentum. Fortunately, on a short-term basis, you're already seeing China get oversold, so that bodes well for the S&P 500 to sort of follow suit over the near term.
So, Katie, in your note, what to watch for this week, you also talk about commodities, crude oil consolidating in the high 60s a barrel, basically about mid-60s level right now. So do you expect that to hold?
Right, that note was from last week, but I do expect some consolidation in here within an intermediate term uptrend that we've seen. I think what to focus on the crude oil chart is the fact that it had a rounded base in place. It did break out, yielding a target in the low 80s per barrel. So any consolidation I would view as, again, sort of a pullback or counter trend move, just like in the broader market.
And then gold, we're seeing a safe haven. We're not, rather, seeing a safe haven play in gold today as it comes back. But you talk about a triangle pattern. Can you explain that a little further?
The triangle pattern is a pattern characterized by higher lows and lower highs on the chart. It's a neutral pattern in and of itself, but when you do see a breakout or breakdown from that pattern, you tend to get a very sharp move one direction or another. My thought is that it may actually break down from this pattern despite having promising action earlier this year. because of signs of trend exhaustion, not in the commodity, but instead in the gold stocks themselves.
So when you put all the pieces together, would you say it's characteristic of early stages of economic recovery?
It feels like that. Obviously, the market, or the S&P 500 as it represents the broader market, did bottom in March. I think that's a very important low, and that bodes well as a leading indicator for the economy.
All right. Our thanks to Katie Stockton, Chief Market Technician at MKM Partners. Again, many thanks.